case,
Okay, thank you very much.
In this case, the discussion is Irma Mosquera, who is Associate Professor of Tax Law at Leiden University and the Principal Investigator of the International Research Project entitled Towards a New Model of Global Tax Governance in International Tax Law. Now, thank you very much, Cindy, and whatever you want, the floor is yours.
Okay, thank you very much. And I apologize in advance because I don't know if my microphone and my audio is working. If it's not, please my apologize. And that's it. I don't know if I can off my video in order to have a less problems with the connection, with the internet connection. It is possible?
Yes, we can try.
Okay.
We can see the presentation and we can hear you. Just try to start the video.
Okay, thank you very much. Yeah. Good afternoon, everyone. It is a truly pleasure to be here with all of you in Global Tax Symposium. Allow me to briefly introduce myself. I'm Cindy Salvador Marquez. I'm a PhD candidate of Universidad San Ignacio de Loyola. And today I would like to share with you my research work entitled Navigating the Global Minimum Tax in Peripheral States, Peru case. Let me say from start, this is not just a technical presentation about tax law. Rather, it is a reflection on how a development country like Peru can adapt to a global minimum tax rules under the Pillar 2, protect its fiscal sovereignty, transform what seems like a challenge into a real opportunity for a development. Why Pillar 2 matters? Now, to understand why this is a crucial for us, let's begin by setting the global context. Back in 2021, more than 130 countries, members of the OECD and the G20, reached a historic agreement. They decided to establish a global minimum effective tax rate of 50% for a large multinational enterprise. This agreement was not reached out by chance. It responds to years of concern about profit shifting, with the companies move profit to a tax havens, about the race of the bottom to the bottom, where countries compete by a lowering tax rates only to lose revenue without necessarily gaining a productive investment. So, according to the OECD, these reforms could generate between 150 and 220 billion dollars in additional tax revenue each year. Therefore, for a country like Peru, and this is why this research is so important. For a country like Peru, this reform is not as simple of a technical adjustment to international standard. It is about fairness, it is about to protect our tax base, and about preserve fiscal sovereignty in a changing global economy. At this point, you may be asking how exactly does the Pillar 2 works? Well, the logic is relatively straightforward, though its application is complex. Wherever a multinational enterprise pays less in a 50% tax in a given jurisdiction, its related company must pay the difference under what is called the Income Inclusion Rule, or the IIR. But there is more. If the related company does not pay the difference, then another country where the multinational operates can collect the missing tax under what is known the under tax rate profit rule. And we can think, and this is a safety net, someone, somewhere, and will always collect the tax. There is also an important rule for the source taxation, the subject to tax rule, that which allowed countries like Peru a tax-specific cross-border payments, such as interest, royalties, um, up to 9%, in order to prevent the aggressive profit shifting. And finally, to avoid discouraging real investment, there is also called a carve out that excludes a portion of payroll and tangible assets from the calculation. So, in a resume, in short, the system guarantees that multinational will pay at least 50% tax everywhere, no matter what. However, uh, I put my key idea, and that is why I mentioned in my resume on my abstract a dissonant normative. Um, Even with such a clear framework, there is a problem we cannot ignore. Global rules, as elegant as they are, do not always fit in the local reality of the developing countries. As an example, in Peru, this is why I call normative dissonance that is a mismatch between what international rules demand and what our domestic legal system, our fiscal police, and even our political institution can actually deliver. If we adopt, as Peru, this rule as a robot without adapting them, we risk having laws that look perfect on a paper, but it fails because it fails to produce a real revenue, a real compliance, a real development impact. Therefore, identifying and closing these gaps becomes, I think, the first challenge for any country wishing to implement the Pillar 2. So I need to focus specifically in the Peru reality, in the Peru case. In the in the corporate income tax law, we have a 29.5%, and if we include the dividend taxes, we can exceed the 32%. This will appear to place Peru comfortably above to the global minimum. However, and this is crucial, we have a number of special tax regimes, especially of the sector like mining, agribusiness, like Amazon region. These regimes uh, significantly reduce the effective tax rate for some related companies, sometimes even bringing it's below 50%. What does this mean under the Pillar 2? It means that those benefits lose their impact because the relay company will simply pay the difference elsewhere. On top of this, we need to know that in Peru, we have a 70% of Peru economy is informal, which concentrate the tax burden on a relatively small number of a large taxpayer. Our tax authority, SUNAT, I know, and this is true, has made significant progress in digitalization, electronic invoicing, and also they are trying to implement the Pillar 2, requiring a far greater institutional capacity. But uh, we need to analyze, we need to understand that we are we are not the same as the, if we need to compare the countries as a US or maybe China, Peru is different. We have a different rules, and we need to analyze not only in the global context, only applying in the local context. So when we look other countries, for example, we notice very different strategies. For example, South Africa and Malaysia have already introduced the qualified domestic minimum top-up tax. So they can collect the revenue locally before any other jurisdiction does. So we can see a protection of his revenues. Meanwhile, in India and Brazil, have chosen to delay the implementation, using their negotiation power as a large market to secure better conditions. And if we see the Nigeria, for example, that initially refused to join the agreement, citing capacity fee concerns, and also they fears a losing police space, for example. In Peru, however, cannot afford the wait too long, but because doing nothing will mean losing valuable revenue. But we also cannot rush into adopting rules that are unenforceable. We need to balance and preparation. So in Peru, we have different Peru challenges that is explained in my paper. In legal way, we must to reconcile any new tax rules with our constitution, with the stability agreement signed with investor, which guarantee fixed tax terms. In a police perspective, we must to accept that our tax incentive lose value under the Pillar 2 and rethink how to design them so they support productive investment without simple transferring benefit abroad. And the administrative way, we need a major effort to reconcile financial accounting with the tax accounting, and as well to build technical capacity with the tax administration, SUNAT. And in the political way, we must to communicate this clearly to the Peruvian citizens and the business community. So they must to see that the OECD there is not a OECD pressure. It's a decision to protect the Peru revenues. So what is the roadmap for Peru? In my analysis, in my opinion, and this is for my thesis, I think the very first step is to adopt a qualified domestic minimum top-up tax, the QMMTT, which allow us to collect the difference when effective tax rate fall below 50%. In this way, we keep the money in Peru rather than allowing it to be collected abroad. But I think this alone is not enough. We must to review, we must to rationalize our tax incentive, phasing out those that only benefit large multinational and redirecting support towards small as a medium enterprise and toward formalizing the economy. We must to also support our tax administration. I think the drugs administration need to create a pillar 2 unit inside the SUNAT, because we need to train in auditors, hiring specialists in international taxation, and also the Peruvian government must to invest in technology that integrates data with the OECD reporting system. Also, we must to continue with the digitalization. We have a success with the invoices, but we need to improve the cybersecurity in Peru to protect the sensitive taxpayer data, because this is important. And also, at the regional level, Peru should work with the other Latin American countries. They have experience, no? For example, SIAT, in order to share legal models, in order to coordinate compliance tool and negotiate simplified rule collectively. And finally, I think none of this will succeed if there is not a public communication. We need to show the citizens as a culture that the additional revenue, it will be invested in schools, in hospital, and in infrastructure projects that they can see as experience, as a real investment in Peru. In this way, the pillar 2 become not just a technical reform, is like a progress, like a progress in our country. So my main message for this is to the pillar 2 is not only about compliance, is a unique opportunity to modernize the Peru tax police by aligning with the global standards. The country can make its tax system fairer. We can build a more resilient fiscal framework for the future. I think the pillar 2 made at the first look like an external pressure, but I think this could be turned as a catalyst to our reforms. And if a Peru country, if we act with a determination, we design a clear domestic measures, and we can communicate this transparently with our system, Peru can move from being a rule taker to becoming a rule shaper. So can allow.
Cindy, thank you very much for your presentation. Is he here, right? Not here.
No.
It's not here. It's gonna wait for a minute in case that she is reconnecting. She said what she wanted to say. After that, she say goodbye. No, it's gonna wait
She will
for a minute.
reconnect. She will try to reconnect.
Yes,
So we can wait
yes.
for a while.
I've already sent her an email.
if she's well, lasting the connection, probably what we can do is to record the intervention, the comments, so then she can have a look to it to that. I don't know.
Did you hear Alfredo, Irma?
Yeah,
No?
I agree. I think it's better than start sending an email
Exactly.
Yeah,
with all
I
the
think-
comments.
Yeah.
And she can
Probably-
contact me if she wants to.
Yeah, exactly.
Thank you very much, Irma. So whatever you want, the floor is yours. Thank you.
Okay, thank you so much. So I think that this is very interesting to have someone from Peru just looking at Pillar 2 from other perspective. And that's also the merit of this PhD, just looking at Pillar 2 from Peruvian perspective. I think that it's also important to see what are the problems of Peru, what you need to have Pillar 2 or not. And I think that in that sense, I like the fact that someone, Cindy in this case, is trying to attempt to see what is making sense of this Pillar 2 in Peru. And I think that it's also important to see some issues of some theoretical framework that you may be missing in this research. So this is recording, right? Yeah, okay. Because one of the first things that you need to take into account, Cindy, is what are you analyzing and how you are comparing this? And what is your theoretical framework for this? So do not forget that Pillar 2 is only for companies above the threshold of 750 million euro. So then the first question is, are we really need to talk about informality? Do we need to talk about invoicing? If those are completely different things. If we are looking at the 750 million euro companies, there are very few, maybe very few in Peru. And that means then that the problems of implementation of a Pillar 2 will be maybe different. And I will not use informality, and I will not use SMEs, I will not use e-invoicing, that are different topics. I mean, if you're talking about informality, then use e-invoicing, but Pillar 2 doesn't make, for me, a point here. The second part that you have is that you use from Leopoldo Parada, but also from Alison, and there is also the work we have done in legal transplants, and it's important perhaps to define that. So I don't know if you have a chapter with definitions, but if you look at what a legal transplant is, because sometimes you say one size does not fit all, law in the books, law in action, different than the practice. So what do you mean? How do you define that? And normally when we work in comparative tax law and we look at legal transplants, we start with the definition of what a legal transplant is and what Alan Watson, for instance, started. And then after in tax, we have other things on transplants. And then when we look at these tax transplants, then a difference that you need to take into account is why, if we are looking at BEPS as a legal transplant and we are looking at Pillar 2, why those are not the same? Because if you compare, for instance, from BEPS, the principal purpose test, that you can have it in the, is a GAR, a general anti-avoidance rule, that has been included in tax treaties, then it's very clear that there is a transplant there. And a rule that was in principle developed, like if you look at the reading from Judith Friedman on the GAR, principle developed in the UK, and then after move, I mean, Benjamin knows all about the GARs. So he wrote a book on that. But then you see, it's a principal purpose test, how this could be a transplant. But I'm not sure that we can make the same comparison with Pillar 2. Because with Pillar 2, we have the model rules and we have certain different kind of schematic ways, the UTPR, the QDMTT, all the things, that it doesn't really make like a transplant as such. It makes kind of an octopus with different things, that sometimes you have this and sometimes you have that. So the question is, what is this a transplant for you? Why is this a transplant? What is what we are having here? Because also the substance carve-outs showed also that actually, and the qualified refundable tax credit that we created in this Pillar 2 model rules, we tried to figure out all of this. So I don't know how does it fit on the legal transplant. That's the second comment. And I will look at my notes because I think that when you look at, you have to look at the political science if you are going to talk about one size does not fit all, and look at what has been the process also, like Rafael Clement was mentioning in the BEPS inclusive framework and the adoption of the Pillar 2. Also because OECD, of course, what you are saying is true. OECD is in the process of becoming a member of the OECD, Peru, and therefore it means that it may have an incentive. But then if we underline what is happening with Peru and what is happening with Latin American countries, so why they are going to do Pillar 2. And then I don't think that has to do so much about the OECD Peru becoming a member of the OECD. But one of the problems we have in Latin America, and Colombia is a very good example of it, is the tax incentives. Every time we try to have a tax reform, we try to touch the tax incentives, and it has not been possible. So then the question is, why is that then Peru is trying to have the Pillar 2? It's because there is tax incentives, it's because they want to become a member of the OECD, but it's really the Pillar 2, the element that will define everything. So I think that there is a political problem, a political need in Peru, as well in a lot of Latin American countries. We have several tax incentives. You mentioned some of them, but if we start counting how much tax incentives, in Colombia we have at least, it used to have, I don't know if still, 90 special economic zones, free trade zones. And then you think like, how can I change that? So I think that there will be a political reason for Peru to implement the tax incentives, to regulate the tax incentives, and because of that they are doing the Pillar 2. And you see it also that the mining industry, that could be the one who is in the threshold, could be also important for that. I really don't think that informality makes here a big. Peru's tax system is marked by high informality. I don't think that is a point here. And if, as you know, for instance, for these companies, we also have the country-by-country reporting. We also have some countries in Latin America have introduced Action 12 on disclosure of aggressive tax planning arrangements. So we have a lot of information already about companies, and we are still asking Pillar 2 and to have all this disclosure. And so those are some of the points. I think that also the fact of having about tax harmonization, I found it very difficult, because actually in Latin America, but also comparing that Pillar 2 embodies one of the boldest experiments in supranational tax harmonization. I don't think that that will work. I don't think that it's really tax harmonization, because it will be, we have one rule. We will not have so many, like the octopus, what I'm mentioning. So it doesn't really work. Even within the European Union, we have also the problems because it's also implemented by means of a directive. So I don't think that is really the example of tax harmonization. So those are kind of some of the points that I want to give you. I think that also, yeah, so try to see why using the Pillar 2, which problems we are trying to solve here. And also perhaps have a look, instead of looking at India, South Africa, Malaysia, who are really far away, and looking at, for instance, that Colombia also has the same issue. Brazil just introduced the Pillar 2 rules. Uruguay is thinking about it. And the work of Andrea Laura Riccardi about what is good, what is bad of the Pillar 2, what you need to know, perhaps it will be useful for you. I will not go so far away. I will not go to India. I will not go to South Africa. I will not go to Malaysia. I would just stay with Latin America, because Brazil, Colombia, and Uruguay are very good examples of what is happening now in Pillar 2. So, yeah, and I think that also what you are also saying, and it's completely true, that going to the citizen, he doesn't know where Pillar 2 is. We know that there are problems in Latin America, and some of these problems as corruption, really limited resources on the tax. We know that there is a lot of political things going on. And it's true that this citizen doesn't care about what Pillar 2 is. But do we really care about that? Because again, it's a threshold of about 750 million euro. So I don't think that this would be something that we really have to say, bring it to the citizen. But perhaps just try to think about what is your normative framework, what is what you want to analyze, how do you want to do it, and then say A, B, and C from this normative framework. The political reasons, for instance, why countries are adopting Pillar 2. It's really because they want to be the good citizens in the BEPS and inclusive framework, and more even with the political statement, of there is something else. So I think that this fiscal policy dissonance and this administrative practical dissonance, you may need to elaborate a little more on that. we did organize, and Alison was also there, Alison Christians, in 2018, we organized a work on legal transplants. And that could be also some inspiration for you to see how we discussed it at that moment about what legal transplants is. So in terms of everything, and the final point that I want to have is that you are also strengthening administrative capacity through digitalization. But then the question is, what do you want to achieve with this, with the Pillar 2? Again, this is completely different than other problems that we have in tax administrations, like the ones have been mentioned at the beginning on artificial intelligence and so forth. So try to think about what is your normative framework. I commend you for using Peru as an example. I will say that you can look at the Latin American countries, because I know that there is some problems right now. There are countries that say why we are doing this. Is it really because we want to be the good citizens, or just because there are other pressures of political willness? So those are my comments.
Thank you very much, Professor Mosquera. I'm not sure if there are any other comments on the digital room or in the real room. Not on this side. Okay, so this session, as we already said, is being recorded. So I'm pretty sure that Cindy will really appreciate it. If
Joaquin has something.
okay, perfect, Professor Inglis.
Yeah,
Very
so
short.
thank you very much. Just a very short comment. I mean, maybe it's still a little bit looking into the crystal ball, but maybe you want to discuss or take into consideration that if the G7 compromise will somehow make its way into the inclusive framework guidance, which I'm pretty sure it will, then countries like Peru or also Brazil that did adopt the QDMTT, or Mexico, which did not, will find that they are squeezed in between, different policy pressures. So on the one hand, yes, for various reasons, you might want to have a QDMTT for fiscal ones, or maybe, to please the core BEPS membership or OECD membership. But also on the other hand, the US will maintain its system, and the system allows for global blending. So if you have a lot of foreign direct investment from the US, which Mexico certainly does, with Brazil does, with Peru, to my knowledge, has to a lesser extent, but still significant, you might want to still allow US-based multinationals to do this global blending by offering incentives, etc., that are not undone by the QDMTT. So question is that really something you can just project in the future? Or yes, this is what will happen because of fiscal reasons suggest it should be done, or because, living up to the expectations of the OECD is what will drive this development, even though the most important OECD member is now opposing this. I'm not so sure, what will happen. And it's also conceivable, and the question is that even admissible, that you might have a dual approach. So you have a QDMTT just for countries that are not covered by site. So in your legal framework, you say QDMTTs for all of those who have GLOBI, and for all the rest of the world, we don't have a QDMTT. And is that possible? And is that then still something that helps you improve your tax system if you do this kind of dual approach, which adds to complexity, besides the fact that the QDMTT in itself is a complexity monster? So just pointing out that these are also possible developments.
Thank you very much, Professor Inglis. No more comments? Actually, we are running out of time, so we can close the first session of the PhD Global Tax Symposium. Let's meet tomorrow at 1 p.m. Thank you very much, and have a good night.
Thank you so much. Bye.